Hey, welcome back to You Heard It From a CFP. My name is Matthew Coyle. Episode 47 of You Heard It From a CFP. Actually here in Wayzata, Minnesota, my hometown. Today we're going to do things a little bit differently. We're not going to do a traditional video. We're going to run parts 1 and 2 of a series we did for high net worth investors here locally in town, and wanted to get that presentation out to you in the form of a video. So enjoy the material. Hope you're well, and thanks for watching. Bye. Well, good day and welcome. My name is Matthew Coyle. I am the Director of Financial Planning at Advanced Capital Group in Minneapolis, Minnesota. And today we're going to start a multi-part series for the high net worth investor here at ACG. And this is going to be a multitude of topics, everything from your mortgage and your investments to financial planning and how to frame the thoughts around how to manage your money as you go forward into retirement and beyond, specific to the high net worth investor, of course. So we're going to keep this fairly informal. Let's dive into the material and I'll look at what we're going to be discussing. Okay, so we work with a number of groups at ACG, high net worth being one of them, but this presentation, as I mentioned, is specifically for the high net worth investor and some of the concerns that come up when managing money or managing other financial tools for you folks in particular. So let's look at the material we're going to cover. Like I said, we're going to keep this fairly informal, fairly brief, and pack it with as much information as I possibly can to be respectful of your time. So let's look at parts 1 and 2 because that's what we're going to be covering today. We're going to be covering what exactly high net worth means and why does it matter. We'll look at the environment for high net worth investors, which has changed quite a bit, and why you should be important, or why it's important and why you should be looking at that. We're going to look at private equity. We're going to look at private credit as part of this series. We're going to look at private real estate. We're also going to talk about thoughts around your insurance and your mortgage and how to think about those and treat those. And of course, we're going to look at drawing your assets down in retirement. And then finally, a call to action as you manage your money and move toward the next stage of your career and your finances. So let's dive right in. What is high net worth? All right, well, before we begin any material, just a brief introduction about myself. I'm a certified financial planner here with ACG in Minneapolis, which means I am a fiduciary. I'm not a commission sales rep. I do not sell insurance. I do not sell annuities, and I don't sell any products on a commission basis. So full disclosure there, this is not a sales presentation. This is educational only. My focus at the firm is retirement planning, wealth management, portfolio advisory, helping people achieve their goals. I joined the firm in 2017 after being independent for 10 years. My firm and my clients joined with ACG at that time, and then I took over as Director of Financial Planning for the firm here in Minneapolis. So that's a bit about myself, and let's go on to one more slide before we start anything else. So some miscellaneous notes about these slides before we begin, just a few disclosures if you don't mind. These slides are educational only. They're designed to be an overview. Okay, my contact information will be at the end of the material. It is not designed to be tax advice. We will cover some very general tax advice in these videos. Again, this is kind of informal, educational only. Okay, if you have a tax consultant, do consult with them. We do some general tax advice, but we're certainly not tax advisors and can't sign off anything. So just a word to the wise there. And again, it's designed to be an overview. And if you want copies of these slides, they are available. And each section of this series should be about 15 to 20 minutes long. We'll keep it brief to be respectful of your time. And again, I do appreciate you being here, so thank you. So let's look at the first slide and let's go forward from here. All right, so before we get into the why it's important part to be a high net worth investor, let's get into what the heck it is. So what is a high net worth investor? By definition, they are high net worth individuals or families that have liquid assets of $1 to $5 million. Okay, not including your personal residence, does not count toward being a high net worth investor. This definition is generated by the SEC, the Securities and Exchange Commission, which is a governing body that oversees regulatory affairs within our industry and decides who gets access to what type of investments. And there's a whole world out there that opens up to high net worth investors, and we can talk about that in a moment. And as part of the series as well. So not including your personal residence, to qualify as a high net worth investor, you have a liquid asset investable base of $1 to $5 million, not including your personal residence. Now, many of these folks often own a family business. Many of them do. Many of them are higher income earners, and I'll get to that in a moment. Or they have very complex financial planning needs. So in general, that is what a high net worth investor is. And let's move forward here. All right, so in addition to that, there is also a kind of in practice definition of a high net worth investor that the SEC allows to have access to certain investments that non-high net worth folks don't. As I just mentioned, liquid assets of a million plus, a million to five is a million plus is the general definition. The SEC also allows for the definition of an accredited investor, which falls into the same category, which has an income, the person has an income of $200,000 or more. This is also a high net worth or accredited investor. Legally, they are not exactly the same thing, but in practice, they are. So in practice, both are acceptable to meet the definition of a high net worth investor. And now let's talk about why that matters and what kind of investments you have access to as a high net worth investor that other folks do not. Okay, so let's get into the why this is important part now. This is the more important of the what is the why. So when we're talking about high net worth investors, we're talking about an area of wealth management where investors enjoy an expanded access to some of the things that non-high net worth investors just don't have access to. And in the world of wealth management means a lot of things. It can mean money management, cash flow planning, it can mean tax, it can mean investment management, it can be hedge funds and trading, it can be private assets, it can be small independent businesses, private businesses. There's a lot that goes into wealth management, tons and tons of, and it really just seems to get bigger and bigger every single year. And we haven't even covered fintech or other areas that are just expanding by the day, or crypto or anything like that. So high net worth investors enjoy expanded access to other products and services that you just simply don't have access to if you're not high net worth by definition. And this is largely due to government regulations. It started way back in the 1930s when they were trying to clean up some of the scams that were going around. And they decided to create a separate definition of investors called high net worth or accredited investors that were deemed to be sophisticated enough to understand these types of investments, and a lot of the investments in high net worth fall in this category, and so they are just simply not accessible to folks who do not meet the financial definition, which is of course a million plus of investable assets, or accredited investor status of income meeting the regulatory requirements. So I often see high net worth investors who are not ready for the changes coming. Because of this access, you have a lot of freedom and flexibility to do things that I just don't see enough high net worth investors doing, and that's the point of this video, is to introduce you to some of these things, flush the topics out a little bit, introduce you to some of these topics, because again, I just very often do not see high net worth investors taking advantage of the things that they should be taking advantage of, and we'll get into some of those as we go. Okay, so when I say expanded access to products and services, what am I specifically referencing? And then we'll talk about the landscape for high net worth as we move forward in the video here. What I'm referencing are generally four areas. I'm talking about PE, which is private equity, which, as the name implies, it's private equity, non-publicly traded investments in private companies that are looking for investments, direct investments from private equity vendors that work with ACG. Hedge funds, which can be market neutral, they can be growth hedge funds, they can be long short, lots of different areas there to look at. And finally, private credit and private real estate. So private credit would be something like a directly issued bond from a borrower to a lender that you have access to invest in that may not be traded like a traditional bond in the marketplace. And private real estate, of course, again, just what it sounds, private real estate that invests in things like all sorts of different products and services in real estate, everywhere from public storage to healthcare facilities to shopping malls to residential real estate. Anything in that area that a high net worth investor has access to at the private level would be included in that. So those four mainly are what we're looking at there: PE, private equity, hedge funds, private credit, and private real estate. So let's talk about, we're going to talk about each one of those separately, independently within the series on its own part. Let's now talk about the landscape for high net worth investors and why this is important. Okay, the landscape. So simply put, the ground is shifting below many people's feet, and I don't think that many high net worth investors, after doing this for quite a number of years now, realize that the market really has changed over the last particularly 5 years, and why you should be taking advantage of the services and products that you have at your disposal. I open up a lot of portfolio and statements and see a lot of balance sheet for high net worth folks have over the years, And I see a lot of the very similar investments that non-high net worth investors are investing in. And because of the changing landscape, and I'll get to this in a second, because of the changing landscape, you really should be opening up the playbook here a little bit and understanding that interest rates, taxes, and how markets are changing are definitely going to affect the high net worth investor going forward. And if you're not using some of the tools at your disposal, you are really missing out on an opportunity to do that. So let's go forward here and talk about the landscape a bit. And we are going to talk about, to start off, interest rates. Can I call this one interest rates a love story? Because for the better part of 40 years, it has been a love story. We've had falling rates for the better part of 40 years now. And we are getting to the point where, after multiple instances over the years of potential breakout of rates only to fall, potential breakout of rates only to fall, we may be getting to the point now where interest rates are finally ready to break out of their 40-year falling channel. Ever since the early 1980s, we have been in a very, very friendly environment for interest rates. When interest rates as a class fall, when rates fall, it makes financial assets more attractive because they are discounted at a cheaper and cheaper rate, which increases their present values. And as these rates move, and they've been moving quite a bit in the last year, as you probably noticed, this will change the dynamic, particularly for high net worth investors, because they can have access to other products and services that are designed, or at least more and more being designed, to deal with a rising rate environment. And we have not seen a rising rate environment for quite some time. And as I will show in future slides, the best investments during times of inflation, times particularly when rates and inflation is over, let's say, 4%, are equity products, REITs, and not the traditional things that people tend to think of, like gold or other investments. So are we finally breaking out of this 40-year falling rate cycle? That remains to be seen. But we do need to start opening up the playbook a little bit more, because the environment is changing and things are shifting very quickly, and you need to have access to different services to potentially deal with that. All right, so let's talk about how movement in interest rates will affect your portfolios going forward. As I mentioned, we've had a very, very friendly interest rate environment for both stocks and bonds over the last 40 years. They've done nothing but fall over the last 40 years when it comes to interest rates. Now, there is a core belief among investors that the reason you have well-diversified portfolios is to have movements from one asset class that you own offset the other. And in practice, this is mostly true. And there is a core premise built into every portfolio that the reason we don't invest in just one thing or two things, but a multitude of investments, is because movements offset the other. Now, the reality of this is that there have been lengthy periods in American history that people often forget about, and people tend to have short memories, where both stocks and bonds, the most popular asset classes, have moved together and have had a positive correlation rather than a negative correlation. So as rates rise, and let's assume they continue to rise, then in reality, you may have to mix up your portfolios a little bit to include other types of assets, like assets I mentioned earlier, PE, private credit, private real estate, or others, to offset the fact that we may be entering back into another period, might be, we don't know, that stocks and bonds, the more traditional investments, move together rather than separately. Now, it's been a very, very friendly environment with falling rates, but as this changes, and we're starting to see it change now, the reality is that there have been lengthy periods in American history and world history where stocks and bonds move together rather than have negative correlation. So it's important that you open up the playbook. It's important that you start to incorporate other assets as a high net worth investor beyond just traditional stocks and bonds. I open up a lot of portfolio statements from high net worth investors, and I see traditional stocks and bonds and virtually nothing else. It's time for this group to start understanding that the ground is shifting beneath their feet, and they need to start incorporating new asset classes like private equity and some other things I've mentioned. Okay, it doesn't have to be just that, but they need to have access to these other product classes so that they can potentially offset what might be coming, which is a return to near positive or positive correlations among these more traditional asset classes. All right, on to taxes now. I'll keep this one fairly short. We all understand taxes have to be paid. Not our favorite thing to pay, of course, but they are necessary to a certain degree. So let's talk about taxes and the current environment we find ourselves in relative to previous environments. It used to be in this country that marginal taxes were much higher on every dollar, every extra dollar of money that you earned. We used to have marginal tax rates right at 90% in this country on every additional dollar for the wealthiest Americans. Those tax rates have fallen precipitously over the years, and as both the government debt, which is of course represented there with the blue dotted line, and wealth inequality, which is represented by the yellow dotted line there, as those two increase specifically, the pressure will be to raise taxes on the richest Americans, particularly high net worth individuals. Now, how to best deal with this is often a subject of great debate, but it can be asserted, I think, with a lot of with a fairly high degree of confidence that high net worth investors will be looked to first to fill this gap when it comes to providing for government coffers and some of the things we'll have to pay for in the future. Other investments besides just traditional stocks and bonds have an excellent mechanism for this, or a better mechanism for this than you may expect. So again, it's time to open up the playbook a little bit, especially for high net worth investors, and to understand that when it comes to both interest rates and taxes, the ground is shifting and you need to start to consider other investments. Okay, let's talk about the markets now. So in addition to changes in rates and changes in taxes, the market's structure and how many public companies there are these days has changed quite a bit ever since I first entered the industry. When I first got in the industry about 20 years ago, there were far more public companies, publicly traded companies, than there are now. It's just that the biggest, the largest of those companies has carried the index with them, and the markets are larger than they've ever been by market cap, but companies now that are still in the indexes are much larger than they used to be. As far as number of public companies and diversity of the markets, there used to be a much larger number of public companies, about double the number of companies that were public when I first entered the industry back in the late 90s, or mid to late 90s, that there are now. In fact, there's a growing number of private companies that seek financing, and private industries that seek financing from the markets, and the private markets as a result of that have really matured. There are far more private companies that are in the United States today and around the world than there are public companies, and this is quite a change. Now, there's always been more private companies than public companies, but the number of public companies and the number of investments you have access to invest in has just shrunk by a large degree. So the number of private companies, in addition to the private markets, have matured. So you have more people chasing the same investments, and a lot of the activity has moved from the public markets into the private markets as those private markets have matured. And if you're not accessing those particular investments, you are missing out on a very wide swath of the investable asset base. All right, in addition to the number of public companies that you can invest in being reduced over the years, the profits at said public companies are slowing over the years. Now, this data courtesy of Standard & Poor's. Of course, over the last 20 years, about half as many S&P 500 companies have seen their revenue grow, their growth at greater than 20%. This is far less than it used to be, roughly about half. So about half the companies now see revenue growth that they used to in the neighborhood of 20% or above that. So in addition to the number of public companies that are available to invest in shrinking, the profits at those companies are shrinking as well as far as their growth, even though those markets have matured and gotten larger. So as activity has shifted somewhat to the private markets and those investments have moved to the private markets, these companies that are still on the public exchanges, as you would expect, as companies get larger, their profit growth slows. And we're seeing the same thing in the public markets as markets have matured. All right, in addition to the equity markets being a little smaller than they used to be as far as quantity of investments available for the public to buy, bond prices will probably not produce the returns they'd have over the next 30 or 40 years that they have the previous 30 or 40 years, most likely, is the agreement among most market prognosticators. And the reason, simply because they will face a headwind of rising rates, which of course hurt bond values over the long term. Now, in an environment of falling rates for 30 or 40 years will artificially increase bond prices because bond prices increase as rates fall. The price of a bond and the rate or the yield of a bond are inversely related, like a seesaw. They move in different directions. So as interest rates rise, the bond value of an existing bond will fall, theoretically fall, simply because it makes each coupon payment worth less, because there's no way to adjust for that on an inflationary bond that doesn't have an inflation adjustment to it. So a simple way to say this is that bonds are probably not going to provide the type of returns like they have in the market the last 30 years. And as a high net worth investor, you need to be looking at some other options in the area of private credit that may help offset this and give you access to other investments that may provide you some additional return in the future beyond just traditionally publicly traded bonds. All right, as we start to wrap things up here in part 1 and 2, let's talk about supply and demand. Good old-fashioned supply and demand, driven by, of course, our largest generation, the millennials. The millennials now are the largest generation. They are larger than the baby boomer generation. The baby boomer generation, of course, controls the vast majority of the wealth in this country, in the US, and around the world, really. But the millennials are the largest growing and fastest moving of the generations as far as the money that's moving into the marketplace, the money that they're deploying for retirement. And when you survey them, when you look at the reasons why they're investing, the reasons are very simple. More than half the time it's retirement. They are investing for the long term. This goes back to my just a moment or two ago when I discussed the fewer number of publicly traded investments available to buy. This feeds into the argument that a larger pool of investors, including the baby boomers and the millennials together, and Gen X, myself, we are all chasing the same investments. The investment pool is essentially shrinking for non-high net worth investors. You have a larger number of people chasing a smaller number of investments. Those prices will become very hard to get better and better prices on, just due to the law of supply and demand. And as a high net worth investor, you need to be deploying additional tools to deal with this. And as we have this larger and larger group chasing the same investments that everybody else is chasing, price discovery becomes very difficult. It becomes harder to buy things at a cheaper price, and therefore your future return would theoretically suffer. So opening up the playbook a little bit, understanding that you have some other tools at your disposal as a high net worth investor, and understanding this dynamic of supply and demand will be helpful going forward because you need to deal with it, and the landscape is changing. All right, so let's sum up before we move on to the next series. So I've talked about interest rates moving higher. I've talked about taxes poised to move higher. I've talked about fewer public investments available for purchase, with more investors chasing that same pool of investments. Price discovery will be a lot more difficult. And of course, your return theoretically would suffer in that particular case. The private markets are maturing more than they ever have. It used to be when I first was in this business 20 years ago that you had to have a much, much larger sum of money to get into high net worth private investments than you did before. The technology now is much easier to get into them, and we can get people into private investments for as low as $50,000 these days. It's very accessible. So as the series progresses, we're going to investigate various products and techniques that high net worth investors, we're going to return back to the message of the series now. High net worth investors need to be looking at their playbook. How are they using their money? How are they deploying their capital? How are they using their investments to serve their planning goals? And how can they adapt to changing markets going forward, given everything I've discussed in parts 1 and 2 here? So I'll leave it at that. Thank you very much for coming for this first part 1 and part 2. We'll continue on with the series, and I will begin to narrate some other slides, and we'll talk about some of these investments in further detail. Thank you again for coming. Have a very nice day.